I am excited to be discussing stablecoins. This innovation has been unfairly treated as a pariah by some, but stablecoins are now an established and fast-growing part of the financial landscape. Putatively, stablecoins were originally intended to facilitate holding and trading cryptocurrency, but their proliferation has been aided by providing users with a stable store of value, a means of payment, and the ability to move capital quickly, irrespective of territorial borders. Demand for dollars continues to be strong, so it's no surprise that a more efficient means of accessing dollars has become increasingly popular. With the passage this year of the Genius Act, there is now a clear regulatory pathway in the United States for stablecoin issuers to broaden their reach and solidify stablecoins as a core part of the payment system. I believe economic research has some catching up to do. Economists meticulously study demand for dollar assets and consider how monetary policy may be affected, and the rapid growth of stablecoins affects the supply of loanable funds in the economy. I am encouraged that the Federal Reserve is taking steps to recognize the importance of stablecoins for the payment system. Greater transparency and rising adoption should help us consider their effect on monetary policy as well. Essentially, all stablecoins are denominated in dollars, and their success is at least partly due to the dollar's enduring status as the world's preferred currency. Stablecoins are also contributing to the dollar's dominance by allowing an ever-growing share of people around the globe to hold assets and conduct transactions in the most trusted currency. My thesis is that stablecoins are already increasing demand for U.S. Treasury bills and other dollar-denominated liquid assets by purchasers outside the United States, and that this demand will continue growing. All else equal, this new demand lowers borrowing costs for the U.S. government. However, as a central banker, my focus is on what I believe may be a substantial and long-term force putting downward pressure on a crucial guideline for monetary policy, known as R star. The neutral rate, or R star, is the policy interest rate that neither stimulates nor restricts economic activity when the economy is operating at its potential, once transitory effects of cyclical economic shocks have abated. There are several open questions with respect to the impact of stablecoins on U.S. monetary policy. How many assets will be managed by stablecoin issuers? Will the funds come from domestic or foreign sources? And where might substitution pull funds out of the banking system? What are the systemic risks related to runs on stablecoins? Since monetary policy must be forward-looking, my colleagues and I would be best served by exploring these topics now. In these remarks, I'll focus on the consequences for monetary policy if stablecoin growth follows industry expectations. In short, stablecoins may become a multi-trillion-dollar elephant in the room for central bankers. While I tend to view new regulations skeptically, I'm greatly encouraged by the Genius Act. This regulatory apparatus for stablecoins establishes a level of legitimacy and accountability congruent with holding traditional dollar assets. For the purposes of monetary policy, the most important aspect of the Genius Act is that it requires U.S. domiciled issuers to maintain reserves backed on at least a one-to-one basis in safe and liquid U.S. dollar-denominated assets. These reserves can be held in bank deposits, short-term treasuries, overnight repurchase agreements, or reverse repos backed by U.S. treasuries or government money market funds. Depending on the source of funds used to invest in stablecoins, it may constitute new loanable funds in the U.S. economy or the overall amount of money available for borrowing and lending. Even stablecoins outside the ambit of the Genius Act are likely to boost demand for treasuries and other dollar-denominated assets. Stablecoins that do not comply with the Genius Act can invest reserves in a much broader range of assets, but to be viewed as reliable stores of value, will likely end up still investing substantially in dollar securities with minimal credit risk. Sorry, there's a little reverb. The interquartile range of private sector estimates compiled by Federal Reserve staff roughly projects stablecoin uptake reaching between $1 trillion and $3 trillion by the end of the decade. For reference, the Fed grew its holdings of U.S. Treasury securities by just over $3 trillion during the latest round of quantitative easing in response to the COVID-19 pandemic. In total, under $7 trillion in Treasury bills are outstanding today. If these forecasts prove accurate, the magnitude of additional demand from stablecoins will be too large to ignore. The innovation of public blockchains means that stablecoins can trade freely on rails that anyone in the world can use. This advancement represents potentially transformational change for consumers and businesses outside the U.S., particularly those in emerging market economies or even advanced foreign economies, with burdensome restrictions on their payment systems. In many jurisdictions, low-friction payment rails are unavailable. Banking services to convert local currency or assets into dollars may be limited. Basic banking services themselves may be limited. and billions of people worldwide are subject to capital controls preventing convertibility and access to dollars. Globally, savers disproportionately favor dollars